Hello everyone. In this video, we will be discussing about Module 5 introduction part. So Module 5 is all about costing and depreciation. So in this video, we will be discussing under costing, components of cost and estimation of selling price. These two topics we will be discussing in this video. First of all, what do you mean by costing? So, as per the Chartered Institute of Management Accounts (CIMA) London has defined costing as the techniques and processes of ascertaining costs. And costing is concerned with determining the cost of products and also planning and controlling such cost. Here, I want to give an example for the second definition, what I just now read out, that is determining the cost of the product. We know that the cost of the product usually will vary from time to time and period to period. One particular product few years before, it was very expensive. Now the same product, it is available now, but even the quality was improved, but the price is very low. And one more example, few years before, one product was very expensive, and now the product is very cheap, and vice versa also. Previous few years before, it may be very cheap, and now it is very expensive. Anything we can say, if you take gold compared to the present price, previous price was very less. And similarly, if you take mobile phones, like some years before, if the mobile phones was sold for 15 or 20,000 rupees, means now the same mobile is available for 8,000 or 10,000 rupees. So it is something like the cost of the products is based on it will be determined based on the time and even availability, and even proper planning and controlling measures if we follow, means even we can avoid any kind of losses in the costing. And one more definition is there, that is Belton. He has defined costing as the proper allocation of expenditure and involves the collection of costs for every order, job, process, service or unit. So in examination, you can write any definition out of these three, and when you are writing, make sure that which definition you are writing, that you need to quote it. And what is cost accounting? Cost accounting is formal system of accounting for cost in the book of account, by means of which costs of products and services are ascertained and controlled. And it is different from costing in the sense, farmer provides only the basis and the information for ascertainment of cost. And moving to the next costing classification, we have three major classification, that is a variable cost, fixed cost, and semi or mixed variable cost. We'll see one by one. So first of all, what do you mean by variable cost? Variable cost is something where a cost that changes with the change in the level of activity. So a common example for variable cost is a direct material cost. If I'm buying a new metal for like for the manufacturing purpose, or even for the fabrication purpose, the cost of the new material the same day, maybe it is say for example 200 rupees. Maybe at the end of the day, some of the materials would have been left out, and I will be returning back to the same person, but he will take it only for the 50% of the price, telling that it is the second handed kind of thing. And moving to the second one, fixed cost. So a cost that does not change in total with the change in activity is called as a fixed cost. It means in something, for example, if I'm depositing some amount in bank. Today I'm depositing 10,000. After 1 week also it is 10,000 only. After 1 year also it is 10,000 only. Maybe additionally I may get some extra money based on the interest or the kind of deposits I made. So it is something like a fixed cost. And next one is the mixed or semi-variable cost, which is nothing but a cost that has the characteristics of both variable and fixed cost. This particular example, I can give land example. Today I am planning to buy a land. Maybe that land cost is one cent is 10 lakh rupees. Maybe if I am selling it tomorrow, the land price may be same 10,000 rupees, or it can be 50 sorry, 10 lakh rupees, or can be 15 lakh rupees, or even there are chances the value of the land also may come down. Instead of 10 lakh rupees, it may come down to 8 lakhs or 7 lakhs. So mixed or semi-variable cost, it's something where there will be the combination of both variable and the fixed cost. And apart from this, even we have few more classification, that is direct cost and indirect cost. Direct cost is a cost that is easily traceable to a particular cost object, and every cost that can be easily and conveniently traced to a particular product, customer, branch, plant, or any other cost object is a direct cost. Indirect cost is not easily traceable to a particular cost object. So, and here the examples what I have given, the same set of problems only will be discussing. So obviously we can avoid the confusions when we solve the direct and indirect cost problems. Then moving to the next one, quality cost. So quality cost refers to the cost that are incurred to prevent, detect and remove defects from products. So quality costs are categorized into four main types. First one is prevention cost, so to avoid or minimize the number of defects. Second one is the appraisal cost, so identify defective products. And third one is internal failure cost, that means to remove the defects from the products. And fourth one is the external failure cost, include warranties, replacement, lost sales because of bad reputation, payment for damages arising from the use of defective products. Then what is the product or the period cost? So product cost is nothing but as also called as inventorial cost, which is nothing but the costs that are incurred to acquire or manufacture a product. So this is nothing but a product cost. And the period cost is nothing but the costs that are not included in the product cost. Not included in the product cost, we call it as a period cost. Usually these costs are not a part of manufacturing process, and therefore it is treated as a expense for the period in which they arise. So period costs are not attached to the products. Next is decision making cost and accounting costs. Decision making costs are the special purpose costs that are applicable only in the situation in which they are compiled, and they have no universal applications, and they need not to tie into routine financial accounts. They do not and should not conform the accounting rules. And accounting costs are compiled primarily from the financial statements. They have to be altered before they can be used for decision making. Moreover, they are historical costs and show what has happened under an existing set of circumstances. Next is relevant and irrelevant cost. Relevant costs are those which change by managerial decision. Irrelevant costs are those which do not get affected by the decision. For example, if your manufacturer is planning to close down an unprofitable retail sales shop, this will affect the wages payable to the workers of your shop. This is relevant in this connection since they will disappear on closing down of your shop. But prepaid rent of a shop or unrecovered cost of any equipment which will have to be scrapped or irrelevant cost which should be ignored. And we have shutdown and sunk cost. A manufacturer or an organization may have to suspend its operation for a period on account of some temporary difficulties. Example, shortage of raw materials, non-availability of requisite labor, etc. Costs of the idle plant are known as shutdown cost. Sunk costs are historical or past cost. These are the costs which have been created by a decision that was made in the past and cannot be changed by any decision that will be made in the future. Since sunk costs cannot be altered by decisions made at the later stage, they are irrelevant for decision making. So with this, I'll be winding up this video, and I'll be discussing the cost related numericals in the upcoming videos. Thank you.